a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about carbon trading ETFs. These are among the top performing ETFs in the market over the past year, but many of you may not even have heard about them. So we'll look at the carbon markets and some of these ETFs that provide exposure to these carbon markets. So we know that the governments around the world are focused on moving towards the goal of net zero emissions by 2050, which is set by the Paris Agreement. And some of the largest companies have voluntarily committed to a net zero emissions target because investors care for the environment, they care for climate change, and also because some of the investment giants like BlackRock, they are forcing these companies to reduce their emissions. So Microsoft and Apple, the two largest companies in the world, they are moving towards carbon neutrality. And Microsoft has announced a plan to be carbon negative by 2030. Apple is already carbon neutral, and they announced plans to be carbon neutral for their supply chains also by 2030. So these companies are investing in renewable energies like wind, solar, hydrogen. They are also investing in carbon capture technologies and storage, which are some of the emerging technologies. And but reducing emissions is not easy, particularly for certain industries like airlines. So some of them are turning to carbon credits, which are also known as carbon offsets. And there is a good illustration of how these carbon offsets work on nature.org website. So if you want to learn more about them, you can go to this website. So basically, carbon credits or carbon offset schemes, they allow companies to pay someone else to plant trees or to not cut trees or take some other steps to reduce greenhouse gas emissions. Another way for companies to reduce the carbon footprint is to buy and sell carbon allowances. So this is called cap and trade scheme. So these in these cap and trade schemes, basically governments set a cap for overall emissions, and those caps are tightened over time. And big carbon emitters or polluters, they have to buy these pollution permits or emission allowances because they want to stay under those regulatory caps. And companies that fall below those limits, they can sell their excess carbon emissions allowance. Now, we know that European Union has much stricter regulations for emissions control. So that is why they have a much larger and much liquid market for these cap and trade schemes, though California also has a market. Now, whether you should invest in these markets, well, it is socially responsible investing, and we know that socially responsible or ESG investing is one of the hottest trends in the markets over the past few years. So this is another way for ESG conscious investors to invest. And also the prices of these carbon credits that usually goes up with inflation. So these could be potential inflation hedging tools too. But remember that these markets are not very well developed. Some experts also say that they lack proper standards and oversight. So this investment could be volatile. That investors should remember. Now we are taking a look at two largest ETFs that invest in these markets. The biggest one is by CraneShares. It's been around for quite some time. The ticker symbol is KRBN, and it invests in these allowances through futures. And basically, it invests in three major cap and trade programs. Has an expense ratio of 79 basis points. And as I mentioned, it is pretty popular with more than 1.4 billion in assets. Now, to learn more about this ETF, in fact, you can also go to European Union Cap and Trade Program website to learn more. But to learn more about this ETF, you can go to the quote page on Zacks.com, and from there you can go to the external home page, the CraneShares web page for this particular ETF, and you can learn more about what exactly it holds. So it holds European Union allowances, it also holds California carbon allowances, and some other regional allowances. Now, the second ETF, the second biggest ETF, is actually an ETN. It's an exchange traded note. And I have talked about exchange traded notes and the difference between ETFs and ETNs in other videos, so I'll not spend a lot of time. But basically, it tracks an index and it promises investors to provide returns of those index, but it actually doesn't hold anything. So the index that it tracks is an index of futures contracts on European Union ETFs. This has about 115 million in assets and has an expense ratio of 75 basis points. Now, again, to learn more about this ETF, you can go to the quote page on Zacks.com. And from there, using the link, you can go to iPath webpage for this ETF. They have some research on what exactly are these emission trading systems and what the ETF holds. It basically provides the return of futures contracts on carbon emission credits from world's major emissions trading mechanism, which is the EU ETS. Now, there are two more ETFs which are basically very new. It's the CraneShares, the one which focuses on European Carbon Program, ticker symbol KEUA, and there's another one which focuses on California, but I'll not spend a lot of time on those because they are basically very new. They launched in October of this year. But if you want to learn more, you can go to the CraneShares webpage and learn more. But on the last slide, I have the comparative performance of these two ETFs versus the S&P 500 index. And you will see that the ETN GRN, that is up more than 175% over the past year, whereas the ETF, the bigger one, KRBN, is up about 120%. Now, European, the one which tracks European futures contracts has done much better because, as I mentioned, those markets were more developed. And last year, when Europe had a bitter winter and the inventory of liquefied natural gas was very low, so the markets needed to burn more carbon intensive fuel, which is coal, and they had to buy more of these allowances. That is why the prices of those allowances surged. And that is why the ETN has done much better than the broader ETF.